Welcome to today's presentation, New Year, New Financial Goals, brought to you by CapTrust, the independent financial advisory firm that works with your employer-sponsored retirement plan. As an added benefit, you also have access to financial advisors who will give you unbiased, customized investment advice. I would now like to introduce Deborah Gates, Manager, CapTrust Financial Wellness and Advice Team.
Thank you so much. We are here to give you unbiased advice about your plan. We cannot give you any legal or tax advice or accounting advice. We make sure that we work within our professional competencies. But what I do want to tell you is that everyone's situation, everyone's financial goals are different, and we treat them as such whenever you're reaching out to us on the advice desk. And so I'd like to get started with this presentation today. I have some guests with me that will be with me today. And I just wanted to take a moment to introduce Liz Ulrichson and Brian Eichler. So Liz has been is a financial advisor, relationship manager, and she's responsible for providing plan advisory services to our corporate fiduciaries and their employees. Brian has over 20 years of experience and leads our advice desk. So I want to thank you both for your willingness to share your wealth of knowledge with us here today. So welcome to the meeting. I really appreciate you taking your time to do that. So without any further ado, as people continue to pour in, I do want to kind of level set a little bit for today's presentation, because today we're not giving the news that we're giving you is things that you can use every day in setting your financial goals. And when we're looking at the beginning of the year, it's the ideal opportunity for you to begin pondering the monetary objectives you need to accomplish in 2024. And so when you're setting your financial goals, it's crucial to track your progress, measure your success, get some personal direction about your personal finances, make your goals really clear. It's easy to lose focus, to overspend, to neglect significant progress. So I want to tell you today, there's not any like earth-shattering news. This is all information that you've heard before. So it might be basic for some, it may be new news for other people, but I just want you to listen and really, do what we're suggesting. I think that's the most important thing is being a doer and not just a listener. And so this is what this is going to take for you to hit your financial goals, is actually set your financial goals, and then what we're suggesting that you need to do, that you actually act on that. Would you tend to agree with that, Liz and Brian?
Absolutely.
Okay.
Yeah.
So today I want to start with a polling question, and I just want you to think about this polling question that I'm going to pose, that we're going to take from you. So, what areas of your financial wellness are you planning to review this year? And so I want you to choose all that apply. You're thinking about your expenses, you want to make some adjustments there, you want to be really cognizant of your contributions. Are you going to make beneficiary changes, investment changes, or something else? So Lucy, can you launch the poll, please? And so while she's launching that poll, Liz, what do you think that most people are thinking about when they're looking at their financial wellness?
I think for me, and especially with inflation and how expensive everything has been the last couple of years, I think expenses is a big one.
Mm-hmm. How about you, Brian?
Right, it's the same. The around the budgeting, where's our dollars stretching to, and then how can I sort of reach my other goals that are now potentially being impacted by the cost of goods being higher.
Right, because all of these things are important that you would, you would want to do, but just which ones are you focusing on? Which ones are more amplified for you? All right, so let's see the results. Rachel, Lucy, can we see the results of that? Wow,
They're
and you
showing right
got,
now.
yeah, you're spot on. So there's really a tie between how much we're spending, the expenses that we have, how our investments are doing. And so these are some of the things that we'll talk about today. And then, we'll kind of hit a little bit on investments. And that's usually in our second quarter. We are going to do an entire presentation on investments. But of these, some of the things just to be cognizant of that you want to pay attention to. All right, so let's dive in to this. And the first thing we want to look at, I think we would be remiss if we didn't start this talking about tax season because we're right in the middle of it. And just want to kind of go through a couple of things, look at it at a cursory level as far as taxes are concerned. So, Liz, what are some of the things that we should be like really thinking about when we're looking at our taxes for the upcoming season?
Mm-hmm. Well, I think the first point on the slide there is a great one, just gathering all the documents. And one thing I really like to recommend is as you start gathering documents, make yourself a checklist. I found that this makes it a lot easier once your tax situation becomes more complicated, right? So gather all your W-2s, any 1099s you may receive, if you get a 1098. And then once you start making that checklist, just keep track of where those forms are coming from, which company, how you're getting them. Are they coming through the mail or do you have to log on and download them? And then what they are related to, which investment account, if it's, the 1098 for a mortgage or student loans, whatever it is, just all the information you can keep in that checklist, I find is really helpful.
You know what, you make a very good point, Liz, that to know how you're going to get that documentation, because there are some things that come through online that you may not remember to download instead of looking for everything coming in through the mail. So that is very important for knowing that.
Yeah, I think a lot of companies have also changed that as well. In the past, it was just automatic that tax documents were always mailed, and now they're kind of switching to be more online. And they may send you a letter telling you that they're switching to be online, but we all know how it goes when you're busy. The mail kind of piles up on the table for a week or two, and you just don't pay attention to one letter telling you that your tax documents will be online. So I do think that's important. Deadlines, of course. For most of us, tax day is April 15th, unless it's delayed due to a holiday. So by April 15th, you either need to have your taxes filed or you need to submit a request for an extension for your taxes. So I think that's important to know.
And then as they can, after you've gotten those documents, know what your deadlines are. So then where do they go from there? Mm-hmm. And thinking about making sure that everything is right, that they didn't forget anything or forget something online, kind of.
Yeah, reviewing your tax return from last year is a great place to start. I also like to go to irs.gov. It has a lot of great resources. There's a calculator out there where you can calculate how much you should have withheld from each paycheck. You should really revisit that anytime you have a major life change. So getting married, divorced, having children, gaining dependents in some other way. So just anytime there's a major change in your life, you get a raise, you should probably revisit your withholdings just to make sure If you're getting a refund, you probably should have less withheld. If you're having to pay in, you should probably have more withheld through your paycheck.
Mhm. And so how do you decide? I mean, I'm sure it depends on the person whether or not they should file with IRS, with a tax professional, when do you do that?
Yeah, it's a great question because tax professionals are worth every penny, in my opinion. They do great at their job, but it's not everybody needs a tax professional, right? If your tax situation is not very complex, it's pretty easy to file on your own. Once it starts to get more complex, and I don't know very many people who enjoy filing their taxes. So if that's something that can take that burden off of you, I'm hiring a tax professional, then absolutely I say go for it. But there's so many resources out there anymore, whether you want to meet with somebody face to face or just submit a return electronically. There's so many options anymore.
Yeah, I just think it just depends on the individual. It depends on how comprehensive or how simple what you have to do, but definitely meet those deadlines and make sure you get all of that filed. I think that's the thing that we want to impress upon you the most is making sure you're filing on time. And if you've done an extension, then make sure that you're meeting those deadlines. Anything you want to add, Brian?
No, Liz covered that a lot. I was smiling because I've done some of those things in the sense I've missed a form. I've missed a spouse account that I forgot was opened, and the IRS will let you know that you have. They will. They're your friend. They will let you know you've missed notifying them of something, and they'll help you correct it. So no, yeah, it's really having a checklist, having maybe a conversation with the spouse or partner that you're filing with, if need be.
Absolutely, absolutely. So, we're talking about this new year, setting those financial goals. So, I know we talk about this so often, but we talk about it so often because it's so very important. And so, the first thing that you would look at as far as it relates to your new financial goals is that now might be a time that you need to refresh your budget. And I know we say that all the time, refresh your budget, do your budget, but what does that really mean? Because I know you have to do it. We can talk about it and tell you about it, but it's something that you have to do. And so if someone needs to refresh their budget or create a budget, I want to just talk about the things that you're looking to have for that budget. So can you help me with that? I want to talk to our audience about what does it mean to refresh your budget and how do you do that?
Yeah, I think starting with your income makes perfect sense. And I think this is a great time of year to do it because you're already gathering all those forms showing you where your income's coming from. So any active income, this is income earned from something you are actively participating in to earn a paycheck, right? So salary, hourly wage, commissions, things like that. Passive income, on the other hand, is income that it may take a little bit of initial work at the beginning to get it set up, but typically once it's set up, passive income is earned without really much ongoing efforts needed. So interest earned from investments, rental property income, affiliate marketing income. This is a big one. I want to touch on this a little bit because we are all affected by affiliate marketing income, I would say on a daily basis. Affiliate marketing income is essentially anything you see, Twitch, YouTubers, Instagram, bloggers, if you get email blasts from companies. So I would argue because, I got email blasts this morning and there's always links to products that they're promoting, right? So if I were to click on that link and buy a product, that company would get a portion of that sale. So that's an example of affiliate marketing income. Promo codes on podcasts. I always hear so many promo codes on podcasts. So that's another example. Vehicle rental. Turo is a new app that, you can outsource your vehicle for extra income. So just other items like that that people don't tend to think of unless they are receiving income from those types of items.
This is, it's a different time
Mm-hmm.
to consider that type of income. And I know that there might be many of you that are listening that actually could possibly have that type of passive income. So you just want to consider all of the income coming into your household is where you want to start when you're creating your budget or refreshing your budget. Brian, you going to add anything to that?
Yeah, it's just as Liz said, and you were talking about, it's being aware of what are the resources coming into you, so you can get that documented and tracked. So then when you're working on your outflows, right, your budget, you say this is a source that can solve this problem. We don't want to ignore a source of income, or it should have a goal for where all that income is going. If it's building an emergency fund or something else, right? You just want to make sure you're tracking all your positives.
Absolutely. Great point. And so, taking time out to do all of this and to gather this documentation and getting that for your income, now you want to see, where is this money going? You might want to track what you're spending if you're not aware of where your money is going, because I know we're in the world of ATM cards, we're doing Apple Pay. We don't see it like when I was growing up, that you spent cash for things, or wrote a check for it. But now you really have to keep up with all of that. So we're looking at your expenses. Let's talk a little bit about expenses now that we've talked about income.
Yeah, I think it's important to review your expenses often. It's not a fun activity. I don't enjoy doing it on my own expenses, but I do think it's important going through, and it's especially harder, to Deborah's point, now that we have multiple accounts that we have to pay attention to, right? It's not just a checking account anymore. You may have a couple of credit cards, multiple checking accounts, whatever it may be, but just going through that list and seeing, what am I truly spending my money on? That's extremely helpful when getting started with a budget. And then of course there are fixed expenses, things that typically stay the same from month to month. Utility companies, a lot of utility companies are using budget pay now, where they're trying to even out the utility bill throughout the year. Insurance, mortgage, rent, things like that. Variable expenses, these are things that are obviously going to change from month to month: groceries, entertainment, clothing, gasoline. Brian, anything you want to add for those two?
No, those are the typical thing. I mean, streaming services, things like that, all the things that are variable, like you may or may not do. It's just, you're not going to usually capture everything 100% right the first time through. And so it's just remembering, get the bulk of it and then pick up the small things as they come along. And so it's okay to keep adjusting and tweaking. It's about sort of getting the flywheel going. Get started, and then you can always adjust and tweak it to find those other, whether it's a fixed expense you forgot, or it's a variable expense, or it's a want versus a need. All those things you can build out your plan. It's just about getting started.
Yeah,
absolutely.
And that's a great point, Brian. Sorry, Deborah, I just want to add one thing.
Sure.
I think it is easy to get frustrated with a budget, right? When you do all the work and put all the time and effort into it, and then it doesn't align perfectly with what you expected. So that's kind of where this plan versus actual comes in, because you can plan it all you want, but life happens, right? And things are going to pop up. Maybe your car needs repaired. Maybe you have expenses from a sick child or pet, or whatever those unexpected expenses may be. You're never going to have a perfect budget. So just get started and you'll have to make adjustments along the way.
And I know it might, when you're thinking about your income and your expenses, what you might want to do is just track it for 30 days. I mean, we're coming up on the beginning of the month, March 1st. And if you do that, tracking it from March 1st until the end of March, I think you're going to hit everything that you pay for. So somewhere in that month, you'll find out your mortgage, and sometime during that month, those other expenses, and just to try to really see where your money is going. And that's when you can start making some tweaks. And so it's just a work in progress when you're looking at your budget. So I think people get frustrated because they think I can fix it, I can set a budget, and then I'm done with it. No, it's going to be that continual work in progress that you're working with your budget. And you just have to do it. It's just important to get started and do it and get comfortable with it. The more you do it, the more comfortable you'll get, the more you'll want to do it and know exactly where you are. And so we're looking at income and we're looking at expenses as the first two things. And so now, what about your savings? So let's talk about that, Liz, if you would look at how important it is when you're looking at your savings and how much you're putting aside for your latter years, for when you're not working anymore, or some things that you need to consider while you're still working, and kind of look at some of the priorities.
Yeah, reviewing your contributions into your employer-sponsored retirement plan is a great idea. You should do this often. We have seen instances where somebody wants 5% to be contributed into their 401k plan, but $5 is actually going in. So if you don't catch that for a period of time, that can add up, right, and hurt you. So I think that's important. I think one of the reasons that employer-sponsored retirement plans are so successful is because you set it up once and then most of us don't look at it for a long period of time, which is great. That's how you build your wealth, right? So I think any way that you can set up your savings so it's automatic, whether that's into a savings account, an individual retirement account or IRA, an employer-sponsored plan, any way that you can set it up to be automatic is going to set you up for more success. And then I also like to increase my contribution into my retirement plan 1% to 2% each year. I like to do that anytime I get a raise, so then I don't notice that it doesn't feel like I'm really losing any money, right? So that's just another great way to increase your savings into your retirement plan. Catch-up contribution, so I'll just talk to this a little bit. The limit for 401k plans is $23,000 for this year for anyone who is under the age of 50. Once you reach the age of 50, you can contribute what's called catch-up contributions into both individual retirement accounts and to employer-sponsored plans. So for 2024, that's $7,500 into employer-sponsored plans.
Absolutely. And that includes the 401k, that includes the 403b when you're looking at the catch-up contributions. And I did want to add that we do have some handouts. You might want to download those handouts as we're going through or print them off. So we have like the 1% challenge. And so you can actually look to see what that looks like and some examples of what that would look like for you if you were going to increase your contributions. So Brian, we talk a lot about emergency savings. Help us with that. How much do you need for your emergency savings? How do you get started? And so all of this is, how do you get started? How do you continue? How do you do checkups? Where should that money be?
Well, so we think it's really, really important, and this is not just an age or period of your life, whether you're 24 starting out in your first job or you're 55 or 60. An emergency fund is important to have throughout your life. It won't, it's like any account you need. It may not be static. You may use it. That's the purpose of an emergency fund, to have it there. You're going to have unexpected, unwanted, but hopefully not unplanned for events that will occur to us throughout our life in different ages and stages. And so that emergency fund is so important that when we're talking, especially to a younger person who's just getting started and they're contributing to their employer plan, they're doing them some, they got some excess cash, for like, well, do you have an emergency fund? Well, no. What's that, right? So we want them adding to an account safe at the bank that they're not going to use just for willy-nilly reasons, hence the term emergency fund. And even if somebody says, well, I want to contribute more to my plan, but I'm already getting, let's say, the full match or the employer contribution, it's that important. We want that excess cash going to the emergency fund initially, right? We talk about what are your debt situations? Is that where it should be going? How do we share it? This is all, it all ties back to the budget. If we can free up cash to build the emergency fund as one of your goals, if that's the goal of budgeting, let's say, or it's paying down debt or whatever all is, they all just sort of tie together. And it's just the emergency fund is used throughout your whole life, right? You want to have it, available. I know the first time that when I personally built up an emergency fund, I felt so, proud that I was able to do it. I was so happy because I definitely felt like now I didn't have to use my credit card to pay for something. And when I did have to spend it on something, I was like, oh, but then I was energized to rebuild it because I knew I did it once. And so the flywheel was going. It just wasn't hard to rebuild it once I had to actually tap into it some. So it's just so important to have that so you're not trapped in that high interest credit card use when you didn't want to, right? You lost control. It wasn't under your control. And that's where it all comes down to the budgeting part we were first talking about. It's budgeting, even though it's so hard, as Liz says, and it is, it's like 90% us and 10% tools in action. It's you gotta get out of your own way. And starting small, starting with small little goals. You can even build in a reward system for yourself as you're doing that. And there's just so much you can do with budgeting, but it's a positive thing. And that's where it helps to sort of get that in your mindset that it's something you're doing for yourself. Think of it as even being selfish if you want to, if that helps, that you're doing it for yourself, that you are going to pay yourself first before that money goes out to some other company or some other business or some other product. You're paying yourself first, and that can potentially help. But anyway, that's about emergency funds.
Right. But when I was thinking about, if you're starting one, I mean, we all have direct deposit. Most of us have, direct deposit, and sometimes you can just set it up as a discipline for yourself, is to say, okay, I've got like 2 accounts. I want this amount, $25 to come out of my check every pay period. And so then you have some type of system, and then increase that the next year to like maybe $30 every pay period. But at least you would have something toward an emergency that those things come up. Because the one thing about emergencies is you can't plan. That's why it's an emergency, because it's something that's come up. And so then you would be prepared for that emergency. What about their investments? Because I saw that was like the top 2. If people want to look at their expenses, and they want to look at their investments.
I'm going to add one thing to what Liz talked about on that 1% challenge. It's the 1%. We often, I mean, it's a conversation we have at the advice desk. We talk to a lot of people about their contributions. They want to know if they're contributing enough to get to where they want to be. And that 1% can seem intimidating to people as well. But when you break down the numbers on a per paycheck basis, especially if you stick with pre-tax where you're getting a tax deduction up front for it, it has less of an impact on your take-home pay than you may anticipate. And when we run some numbers as estimates for people, they're usually shocked, like, oh, I had no idea it was only going to be $17 out of my paycheck. I can do that. And then they're excited because they're like, now I know. And so part of it is just understanding, right? What are the things? So that 1% challenge is quite doable for many people. And if it's not doable this year, then maybe it's next year, right? You don't want to give up on saving more when you know you can, just because of sort of inertia has stopped you in the past. Now, leading to investments. That's another one of our top topics at the advice desk. So as a general rule of thumb, you definitely want to review your investments on an annual basis, especially if you're building and managing your own portfolio, right? We want to help you do what you want to do. And we want you in the right mix, diversified mix of investments to meet that comfort with risk that you have. But it's important to understand that if you're going to go down that path, it typically is not a buy and forget kind of investment strategy, because if you're managing this, you need to continue doing your research. You need to ask yourself, do I still feel comfortable in this environment, with these family events that happen, with the job event that happened, whatever's happening in the macroeconomic environment, you want to align your comfort with risk to your investment strategy. Now, if you're using another strategy that's more hands-off, let's say like a target date fund, then you can be in that from 25 to 65 and have done nothing in between. And that's a very popular strategy for many people, but it's not for everybody. And that's where we want to have that conversation. But we want you to understand what you're invested in, and we want you to understand the risks involved, and make sure they're aligned to your comfort. Just because you're a young person, it doesn't mean you're comfortable with being an aggressive investor. It's typically what people do, but it doesn't mean that's what you are. And the same way when you're closer and older, getting ready to retire, we talk to plenty of people who want to be more aggressive for whatever reason than maybe the typical. And we want to have that conversation and make sure you understand the risks involved in that. Or maybe it's a small portion in their employer plan and they want to be aggressive there, but the bulk of their assets are somewhere else and they're doing something more moderate in that environment. So it's that conversation and just understanding what you're in and how you want to invest your money over the long term to meet your goals, right? So it's all tied together, that you want to save enough to get to your goal. You want to invest the right way to get to your goal.
And it's what your goals are. And so,
right,
to recap, to refresh your budget, you want to review your current financial situation. You want to look at what you're doing. You want to, update that budget. We've talked about analyzing what those expenses are, and you can make the decision if do you have 4 streaming services? I mean, doing that 30 days, seeing where your money is going going to really help you analyze that, look at your expenses, and then make the adjustments where you would need to make adjustments. You might need to adjust your spending habits. Maybe you take a 30-day hiatus from spending on some of those variable expenses and just try to see where you are. Update your savings goal, and determine what it is actually that you need set aside, and how can you get to that. And then you want to consider if there are any other new expenses that might be coming along the way. So you want to look at all of that, but it's all individual. When you're looking at what your financial goals are and setting those financial goals. So I really kind of want to look at this. We have another handout for it's like a retirement planning guide. And so, Liz, if someone's like in their 20s, in their 30s, or just starting out, getting adjusted to this whole savings piece, what should they be considering at that age?
Yeah, I think creating a budget, I know we've hit on that a lot today, but I really do think it's important. It's great to get in that habit when you're young, because once you reach retirement, it's going to be even more important that you know how to stick to a budget, because you won't have a set paycheck coming in anymore, right? So you're going to have to stick to your budget so you can manage your expenses. So I think as early as you can get in that habit of creating and managing a budget, I think you're going to be better off in the long run. Reduce and manage debt. That's very important with people coming out of school, having student loans. But I do want to clarify one thing, that there is a difference between good and bad debt, right? So when we say reduce and manage debt, we don't mean pay your mortgage off as fast as possible or pay off your car loan as fast as possible. That's good debt. But paying off your student loans and credit card debt is one of the worst debts to have. So paying that off as quickly as possible is important. And investing for your future. It's really hard to try to manage paying off debts and investing for your future, but it really is important that you do both, because the money that you put in at the beginning of your career is going to be the most impactful for retirement. It's going to grow the most over time. Brian hit on it a lot, and I do think it's important, starting an emergency fund and then increasing your contributions 1% to 2% annually.
Absolutely. And if you're just starting out, you want to kind of really set a foundation, and calling our advice desk and having them create a blueprint for you, so you can really get a path and which way you need to go. And optimizing that benefit. Brian?
Yeah, in your early 20s and 30s, right? You're just getting started, and as Liz says, it's hard to sort of see the end goal, right? It's so far away, and we understand that.
Right.
You've got immediate concerns, immediate goals, immediate needs, and 40 or 50 years in the future, some are planning for 30 years before retirement, but and then we've got those decades in retirement. So you might as well add another 20 years on top of that, because we're still managing our money, we're managing our debt, we're managing our budget while we're in retirement, right? So you can't get away from the financial piece of this, right? There's just different things you can focus on and get yourself set up for success. As Liz says, getting funds into the account early and let it start compounding and working for you for extra decades, it just simply has always been shown to be a positive benefit to you rather than starting later in life. It doesn't mean you can't be successful in retirement by starting savings later. It's just going to be different. The percentages that you need to save may be different. Your budget may be different than when we were young and thinking we had our 40 years of working ahead of us. So it's just sort of laying the foundations for what comes later, putting yourself in the best position possible.
Absolutely, absolutely. Yeah. And so, updating your beneficiaries, maybe you had a life change within that year. Maybe, being cognizant of that if you're having children, or creating that will. It's never too soon to start with that will and looking at your assets of what you're starting to attain as you're going through your career on this continuum, and just really thinking about how are you, what are you going to do and how are you going to live, and where's this money going to come from when you're in your 60s and your 70s or in your 50s, and thinking of all of those, just planning ahead. And you might have like some major expenses if you're buying a house, or you're saving for a down payment on a house. You want to think about all of these things, and it's just all in the planning. And you're always planning, you're continuing to plan. And it's just you're just building on these things. So when you're in your 20s and your 30s, you're setting down the foundation, the groundwork that you will continue throughout your career as we go through. So Brian, so say somebody's at their 40s or 50s, what should they be?
Right. So now they've got some life under their wings, right? They've experienced things. Hopefully, they've been doing some savings. Maybe if there's a family involved, things have gotten more complicated than when they were in their 20s potentially, right? So there's more things to consider. That's why revisiting and updating your beneficiaries is really important. That's one of the simplest things you can do to protect your assets for where you want your money to go if something were to terribly happen to you or a family member. But now it's getting closer and you're making progress. So the feelings are a little different here, especially in the 40s, because we're building into our peak earning years, or maybe we change careers and we're building towards something new. But you are so much more closer to retirement that you can actually see it now, as opposed to 40 years ahead. Now we're only 20 or 15 years ahead potentially. And so just considering you start to refine your goals, or maybe they start to come into focus more, whereas it was just more obscured when our younger years. Now we start to think, I think I maybe want to retire at a particular age. I think I need this around a budget. I've got 2 kids versus no kids, right? So you start to think about college expenses. You think about that, right? Or maybe we're already a grandparent, right? And so now we've got something going on there. As we get older, we're starting to really start paying attention to how do we want to start spending our time and money. It starts to come more and more into focus. And so paying attention to, okay, what's it really going to look like? Let me do some more planning. Let's, again, reevaluate our risk tolerance. Have I been to Social Security's website, ssa.gov? We always want to promote you pay attention to your numbers, know your earnings history. They don't mail that letter out to us anymore unless we're closer to 60. So you need to go to ssa.gov. enroll yourself, register yourself, I should say, so you can actually see your live data, right? From every paycheck you've ever filed, they've got the data. You can make sure that earnings history is correct, because your benefits are going to be based off that earnings history. You don't want to wait till you're 60 to look at it the first time.
Absolutely. Absolutely. And as you go into your 60s, you're thinking about when you're going to take the Social Security. Am I going to take it at 62? Am I going to take it at my normal? Or am I going to take it later? And that's when you're getting into those questions about Medicare and, you know, your estate planning. We have a document in the handouts. It's 25 documents. And that's like, you know, Liz said earlier, when you're gathering your documentation about your IRS and have like a little checklist. Well, this is like a little checklist that'll go through the 25 documents. And do you have to gather all of that information at one time? Absolutely not. But as you're gathering, as you're going through the years, start gathering that information about your documents. I see that we're scurrying through the time. I want to give you some time, Brian, to you know, we want to talk about, you know, tracking your progress. We spoke earlier about that, refreshing your budget, of course, you know, analyzing it, going through that information, and then setting your financial goals. And we kind of talked about it by age. But let's look at tracking your progress. We do have a document in the handouts, and it is like a spreadsheet if you want to do it analog. And I think it's like Liz said earlier, it's not so much as, you know, the application that you're using, it's that you actually do it, and that you get involved with it. So Brian, you know, talking about tracking your progress, this conversation with the advice desk, let's talk about a little bit about the blueprint.
It's a wonderful tool. I love this tool. Any planning tool can be a benefit to you, as long as we're using it correctly. When you're running analysis, is to see where you are with your projections. But it's important because you don't want to wait till 2 weeks before you retire to look at your first budget. And I have had that conversation with somebody who was almost ready to give their notice, and they had no idea what their budget in retirement was going to be like. So we put a hard pause on that for a short time until they could gather their documents, do a little pencil to paper to find out what did they want to spend versus what they'd already saved now, because now we're at the end of our working career, and we don't have time to start building assets really, if they really want to retire. And this planning tool, the retirement blueprint, allows us to start with somebody who's fresh out of college, their first job, or somebody who's nearing retirement or in retirement, and say, look, this is the purpose. This is what it can look like if I save this amount over this period of time, doing these things with these spending goals or extra savings goals built in. And we can mimic this out and show people these projections, whether it's with or without Social Security, with pensions, without, with part-time work, with spending, you know, wedding, college savings for the kids or grandkids. All of this is valuable data. I can't imagine trying to retire without running a planning tool to see. And I want to run as many scenarios as I possibly can think of to reinforce that I'm doing the right things. So we can show the differences in Roth and pre-tax contributions, a combo. We can show so many things, but it's so powerful to show you what it looks like, that as you spend the money, right, the money is going to go down potentially, but not always, right? Do we have a high budget, a low budget? Right? Where are we? Are we balancing the assets we've acquired to the spend? And that's something that you actually do need to review on an annual basis, even in retirement. There is not one tool that's just going to show you the rest of your life that's going to go perfectly, right? There's too many things. You need to review your taxes. You need to review how the account did, right? Accounts go up and down even in retirement. And so you want to manage your risk as you get closer to retirement, so you're comfortable with those fluctuations in the market. So a planning tool is just a terrific thing to do with the advice desk. And we hope you call or make an appointment to run a blueprint if you haven't. If we did one years ago, it's time to update it. We want to try to do them one a year. As things change in your life, we want to keep doing them. As you think of scenarios, we want to keep doing them.
Absolutely, absolutely. And you find that it's very helpful. I know that you're meeting with clients, Liz, to how important is that, and how do you promote and encourage people to come on to this blueprint?
Yeah, absolutely. It typically takes a little bit of word of mouth from other participants once they've run a blueprint, and then they go and tell, you know, their colleagues how impactful it was. But it's a great tool. We can kind of tweak a few things as we're running the blueprint, you know, the income goal in retirement, when they want to retire, and how much they're contributing into the plan are the three factors that are going to make the biggest difference in the outcome. But it really does help solidify that, oh, I've never really thought about how much I actually spend each month. I should probably look at my budget and figure out that number before I make the decision to retire.
Yep.
Absolutely. And what I like about the blueprint and having it's a conversation. And so you're guiding that conversation, whatever your financial goals are, that they'll talk about the professionals that are on the advice desk. And it's not an intimidating conversation. It's a very warm conversation that you're having, because the data is the data. We want to know the why behind the data. So that's the wonderful thing about utilizing this tool, because there's actually someone you can talk to, because there's so many inputs in other tools, and you might not know when to put this in or when to put that in. You can have someone that you can just tell them the information, and they can guide you as to what information that's needed. So strongly encourage you, and I'm going to put up that information, how you can contact the advice desk, set an appointment, setting as many appointments as you would like to set, as much as you would need. And so we're coming up on time. I do want to leave some time for some questions. And so in looking at tracking your progress, but track your income and your expenses. And that's why I said that 30 days of just writing down, or whatever tool that you want to use to do that before you come to a session, just kind of see what kind of income, expenses, and then schedule some of those check-ins, and see where you are, and then call CapTrust. We are definitely here waiting to help you. So I'm going to put up the questions. I'm going to put up the information how you can reach out to the advice desk. You can either go on to captrustadvice.com, schedule an available appointment that you want, or you can call directly at 1-800-967-9948. And of course, the hours of operation Monday through Thursday, 8:30 a.m. until 8 o'clock p.m. if you're scheduling that appointment. On Friday until 6 o'clock p.m. If you're calling in directly, 8:30 until 5:30 p.m. Monday through Thursday. On Friday, 8:30 to 4 o'clock p.m. So I want to ask Sarah if there are any questions. And after I want to still leave a little bit of time. And if you have any closing remarks, we'll want to get that from you, Liz and Brian. But Sarah, are there any questions in the question pane, please?
Deborah, thank you so much. There was definitely a lot of questions coming in. We've had an active bunch here. I did put some videos and articles in the chat. So if you haven't taken a look at the chat yet, definitely go check those videos and articles out on your own time. But we do have a couple of questions regarding the blueprint. Brian, a couple of questions came through about how do we go about using the blueprint? Is the blueprint on our website somewhere? How can we go through this blueprint process?
That's a great question. So the blueprint itself is a pretty advanced tool, and so it can only be run with one of our advisors. So that's making that phone call or making an appointment that we'll call out to you. Of course, when there's an appointment, we'll call out to you. And then we try to screen share, because we want you to see the inputs. We want you to see the graphs. We want you engaged in the conversation. We can't do this alone, right? You're on a retirement planning journey. It's your journey, but we can help along the way. We want you there with us. And so the tool itself, there's a simpler tool on our website. It's a more basic tool under the captrustadvice.com website under resources. There's articles, videos, and tools. And in the tools, there's a retirement planning calculator there that's available. But it will not capture nearly as much information as what the blueprint can do. And we'll talk through those inputs. As Deborah said, it's the conversation that we're having. Because we do hear from a lot of people who say, hey, I saw I needed to save $2 million to retire. And we're like, where'd you get that number? Is that your number? I don't know. That's what, but now I can't do it. I can't possibly save that. So I'm upset. And when you run a blueprint, you can talk about their actual budget and their actual savings and find out, like, you know what, they're in fine shape. No, they're not going to have 2 million, but they didn't need 2 million. They were going to be just fine with a lower number because everybody is unique, as Deborah said.
Absolutely.
Can I add one thing to that quickly, Brian? We're not trying to sell you anything either. I think a lot of people get concerned about calling into a financial company thinking they're going to get sold an annuity or something along those lines. That's not our goal. This is a benefit provided by your employer. Our goal is to help you reach retirement successfully. So we're not going to sell you anything. I just wanted to make sure that was said.
Yeah, good point, Liz. Yeah, we're part of your benefits year round. Talk to us as much as you want. We're here to help you. That's all we do is help. We talk and give advice all day long at the advice desk.
Very helpful. Thank you. Brian, just another question regarding the blueprint, specifically with those estimates of Social Security benefits. Where can we go and see our estimated Social Security benefit, or how does that work?
I love that website. I got SSA, Social Security Administration, ssa.gov. And if you've never registered yourself, you'll register yourself to keep everything good and secure. And then it'll obviously know you personally and your earnings history, because it'd be dealing with your Social Security number. And you're going to then get your estimates. And they even have slider bars now. So it used to be 62, 65, and 67, and you didn't get to see any of the in-betweens. But now you can move the slider bar around and say, I want to retire at 64, 65, 68, and you can see the different estimates there. And the earnings history is the important part, because again, when we're just getting started and maybe there's only 3 or 4 or 5 years of earnings history there, but still it's important to make sure it's correct. And as you, of course, go through life, you're going to end up with 30 and 40 years of data. You want to make sure it's right, because you don't want to have a big decade where they got it all wrong, and then you're going to have to prove it later that they had it wrong, right? So you just don't want to run into that kind of situation. So ssa.gov, it is your friend.
Awesome. Thank you, Brian. We had a few questions regarding those emergency savings funds as well. Liz, what is a good amount to have saved up in those emergency savings funds?
It really, I hate to give you this answer because I feel like this is kind of our cop-out answer for everything. It really depends on your situation. 3 to 6 months is a good kind of outline of how much you should have in emergency savings, and make sure that they're saved, and to Brian's point earlier, in a place that you can't easily access it and use it to spend on things on Amazon that none of us really need, right? And save it in, it shouldn't be saved in anything. I had a friend once tell me that his emergency savings fund was in crypto. Please don't put your emergency savings fund in crypto. It needs to be not in the stock market. It needs to be in cash or some sort of low interest bearing, easily accessible account, so that if you do need to get to it because of an emergency, you can get to it easily.
Yeah, I'll tail onto that one. So the 3 to 6 months, right? It's an industry average. And again, your circumstance may require more. It'd be hard to convince us that you should have less as an emergency fund, just as a general conversation. But you can set it as 2 goals for yourself if you're trying to establishing or building an emergency fund and growing it. 3 to 6 months of expenses would be the easier goal to hit first, right? Give yourself a reward if you need to at that point. And then 3 to 6 months of income, because we're going to assume that we're making more than we're spending. So therefore, 3 to 6 months of expenses should be a lower target to hit. But if you were out of work for a health reason, or there was a layoff or something happened, that you could comfortably know you can cover your expenses without extra stress while you're looking for a new job or healing. right? A family event. And then the higher one would be 3 to 6 months of income, right? And if somehow you were in a career that was really hard to replace, you could even extend it to 12. Those are just really far out on the bell curve that would be necessary.
I did see just one more question in here that I wanted to touch on regarding online tools, websites, maybe even apps that we can use to help track our expenses throughout the year. I know mint.com has since gone away. Some people may have been using mint.com in the past. Do either of you have any suggestions on budgeting websites or apps that we can use to help track our expenses?
I know in the budgeting webinars that we have promoted different apps, the, the mint.com. One thing I will mention about, there's so many automated tools that you can use either through your bank or your credit card. You want to look at where the spending is coming from. They may have tools to help you. And that's why gathering the data could be really, really efficient and quick. And so that's one place to look at. Look what the resources you already have available. But there are numerous apps available. What we tend to find from people, though, because everybody is unique, no one app works for everybody. They will dislike things about it, so they try another one. So it's be comfortable with making changes is why we kind of brought it up early on. You may find you start with one product and app and then you don't like it, right? It doesn't do something for you. So don't stop your journey there. Try another one, right? Try get recommendations from friends or family who've maybe done it, but you want to try different products. Some people, pencil and paper, it works fine for them, and others like, I'm not doing that. I'm not going to create a spreadsheet. I'm not going to use a free spreadsheet. I want something else. But other people, it works fine. So the different tools that you use to help accomplish it, that really is up to you.
Yeah, just figure out what works for you. I think that's a great answer.
Awesome. Well, thank you, Liz, and thank you, Brian, so much for joining us today. This has been such a great session. Do want to reiterate that it was being recorded and it should be sent out to everybody that registered within 1 to 2 business days. So look out for that recording, but it is at the top of the hour. So we just wanted to thank you all for joining, and we hope that this information was helpful. Please do not hesitate to reach out to CapTrust with any questions that you may have. We are available Monday through Friday, or Monday through Thursday, 8:30 a.m. to 5:30 p.m. Eastern, and on Fridays, 8:30 a.m. to 4 p.m. Eastern. And our number is 800-967-9948. Thank you all so much. This will conclude our webinar. Stay safe and have a great rest of your day.
Thanks, everybody.